Your market news now. Global stocks are at a 15-month high and the euro strengthened as the market's focus shifted to a widely expected nudge in U.S. interest rates to what is almost certain to be a similar move by the European Central Bank later. Investors are now waiting for the ECB at 2:15 South African time, which, like the Fed, is expected to hike by another quarter point as it approaches the end of its tightening campaign. Meanwhile, locally, ArcelorMittal South Africa swung to a half-year loss, blaming the country's electricity crisis, high inflation and weak demand from key steel-consuming sectors. But its Luxembourg-based parent company exceeded expectations when it reported a second quarter core profit of $2.6 billion, half of what it achieved a year ago. To talk to us about the latest, especially from a fixed income perspective, we are joined by James Turp, who's a fixed income portfolio manager at Sanlam Investments. James, thank you so much for your time. So it was widely expected that the Federal Reserve would hike by 25 basis points last night. But what were your key takeaways as Jerome Powell answered reporters' questions?
Thanks for having me, Nastasha. Great to speak again. You've hit the nail on the head. Broadly expected. I mean, the full 25 basis points hike was discounted in the market, and you can tell from the market's reaction that was the case. I think the key takeaways were there was no change from the Fed's forward guidance for interest rates, leaving the door open for hikes and not committing in any way to indicating what that forward path might be. So we have to go and look at what the market's discounting to get an idea of that. But more importantly, it creates a market that now becomes data dependent. So each little bit of data now coming out will complete that puzzle for us.
All right, so let's talk about bond market reaction going into the Fed meeting and then post that press conference.
So the bond markets were holding up quite well. Our bond market, of course, here we've seen our yields compress favorably for bondholders. So the market, as we know, it was broadly expecting this 25 basis point hike from the Fed, but there was a chance that they might hold off on a hike because, remember, they'd paused at the previous FOMC meeting. So that was always a chance, or there was a chance that they could turn slightly more dovish. Of course, the market's looking for an end to the hiking cycle and thereafter the beginning of a cutting cycle, which one would expect. And that then creates asset rallies and value for investors in all asset classes. So that was really what the bond market was looking for, and perhaps this sort of muted response just indicates maybe the good job the Fed's doing in its transparency before the meeting itself.
Speaking of a good job, do you believe that the Fed can get to 2% in terms of the inflation rate without necessarily tipping the economy into a recession?
Yeah, that's the debate, the soft landing, they call it, getting inflation under control without costing the economy growth. And I think, the Fed's been quite surprised, actually, about the strength of the economy and the resilience in the employment sector, not responding to those 525 basis points of hikes we've seen since those zero rates post-COVID. So will the Fed manage to do it? At the moment, they seem to be engineering this soft landing quite successfully, but there are these uncertainties, the biggest of which is the lag of the economic response to those rate hikes. And that's got economists thinking, normally you expect a year to two before an interest rate hike will feed through to the economy. It's not showing up yet. So I guess the concerns are that it suddenly and rapidly comes through in the data. We've got US GDP figures out this afternoon. So at 2:30, we'll be watching those screens to see just the strength of that, the strength of their durable goods numbers. So every, as I say, piece of economic data coming through will help us in figuring that out. But at the moment, they seem to be doing a great job. And in fact, the economy there is seeming more resilient than even they'd expected.
Let's talk about South African bonds. I mean, how do they compare if you look at it on a global landscape within the emerging market space?
Brilliant question, because that's what we are hoping to stick out as a great destination for investment. Of course, we've had a lot of volatility in our bond market over the last 6 months, but when you compare us to other emerging markets, you've got to try and consider similarly liquid markets as our own. Now, our own market is deep liquidity and well functioning. So we do stand out from that perspective. But investors look at yield and they look at forward inflation, indications of where our inflation is going to be in a year or two's time. So from a yield perspective, we do stand out as being fairly attractive compared to other countries. Perhaps only Brazil looking a little bit more attractive from a yield point of view. Then you've got to look at our inflation. Unfortunately, we've got one of the highest inflation forecasts going forward. And so we stack up favorably, but not from an inflation forecast point of view, where you've got also to consider the currency as well. Our currency, one of the weaker, even though we've had this massive strength coming through over the month of July. Remember, we've come down from 19 to 17 and a half where we are at the moment. So that will probably have foreign investors looking, but other countries such as Mexico, their currencies have appreciated against the US dollar this year, and that attracts foreign investors. It's more about stability than strengthening often, because strengthening can be followed by weakening once again. So we need a period of stability in the rand, but at the moment it's looking really good. The rand's been a real beneficiary of our interest rate hikes over the last couple of MPC meetings. So maybe this will entice foreign investors to come into our bond market.